Welcome to investing, or as I like to call it, how to make your money work harder than you do while you sit around eating cereal in your pajamas at 2 in the afternoon. Look, I'm going to be real with you right off the bat. I am not a financial advisor, I don't have a fancy degree from Wharton, and the closest I've been to Wall Street is watching The Wolf of Wall Street on Netflix. But here's the thing, you don't need to be some genius with a calculator surgically attached to your hand to understand investing. You just need someone dumb enough to explain it in terms that make sense to regular people like us. So why should you listen to me? Well, because I've made every stupid mistake in the book, and I'm going to tell you about all of them so you don't have to. I've panic sold during market crashes, I've bought stocks because my cousin's friend's brother said they were hot, and I once spent 3 hours researching a company only to realize I was looking at the wrong ticker symbol the entire time. Yeah, I bought shares in a lawnmower company when I thought I was investing in a tech startup. Don't ask. But here's what happened after all that stupidity. I figured it out. And not only did I figure it out, but I realized that investing is actually way simpler than everyone makes it seem. The financial industry wants you to think it's this mysterious black magic that only people in expensive suits can understand. But that's complete garbage. They just want to sell you stuff and take your money in fees. The truth is, investing is just putting your money somewhere so it can grow instead of sitting in your checking account earning basically nothing while inflation slowly eats away at your purchasing power like a financial termite. And by the end of this video, you're gonna understand enough about investing to make smart decisions with your money, avoid the biggest mistakes that destroy people's wealth, and maybe even impress someone at a dinner party. Or at least not sound like a complete moron when your friends start talking about their portfolios. But first, let me blow your mind with something that's gonna change how you think about money forever. There's this thing called compound interest, and Albert Einstein supposedly called it the eighth wonder of the world. Now, I don't know if Einstein actually said that, but when one of the smartest dudes who ever lived allegedly puts something in the same category as the pyramids, you better pay attention. Compound interest is basically magic, except it's real and it works every single time. It's when you earn money not just on the money you originally invested, but also on all the money that money has already made. It's like a snowball rolling down a hill, except instead of getting bigger with snow, it's getting bigger with cash. The longer that snowball rolls, the more massive it becomes. Let me give you an example that's going to make you want to slap your past self for not starting sooner. Meet Sarah. Sarah is 24 years old, just graduated college, and she's smart enough to start investing $500 every month. Now, assuming she gets an average return of 7% per year, which is pretty reasonable for long-term investing, by the time Sarah hits 65, she could have over $1.5 million. Not bad, right? But wait, it gets better. Or worse, depending on how you look at it. Meet Mike. Mike is just like Sarah, except he waited until he was 30 to start investing. Same $500 per month, same 7% return, but because Mike started just 6 years later, he only ends up with about $920,000 by retirement. 6 years cost him over $500,000. That's compound interest working against procrastination. Now let's talk about Emily. Emily waited until she was 40 to start investing, and by retirement, she only has about $380,000. And poor John, who didn't start until 50, only ends up with around $160,000. Same monthly investment, same returns, but time is the secret ingredient that makes all the difference. This is why I want to reach through the screen and shake every young person who thinks they have plenty of time to worry about investing later. Later is the enemy of compound interest. Every year you wait is literally costing you hundreds of thousands of dollars in potential wealth. But compound interest only works if you actually understand what you're investing in, which brings us to the stock market. Now, the stock market sounds scary and complicated, but it's really just a giant marketplace where people buy and sell pieces of companies. Think of it like a swap meet, except instead of selling old furniture and random junk, people are trading ownership stakes in businesses. When you buy a stock, you're literally buying a tiny piece of a company. If you own Apple stock, congratulations, you're part owner of Apple. You don't get to walk into their headquarters and start making decisions, but you do get to benefit when the company does well and suffer when it doesn't. Stock prices go up and down constantly, and that freaks a lot of people out. They see their investment lose value for a few days, and they panic sell, which is exactly the wrong thing to do. The stock market is like a crazy person in the short term, but a rational businessman in the long term. Day to day, week to week, even year to year, stock prices can do absolutely insane things for no good reason. But over decades, stock prices tend to reflect the actual value and growth of the companies they represent. Here's something that's going to blow your mind. The stock market has gone up in about 73% of all years since the 1920s. That means even if you're unlucky enough to start investing right before a market crash, if you just hold on and don't do anything stupid, you'll probably come out ahead within a few years. The S&P 500, which is basically a collection of the 500 biggest companies in America, has returned an average of about 7% per year over the long term. That means if you invested $1,000 30 years ago and just left it alone, you'd have about $7,600 today. Not bad for doing absolutely nothing. But here's where most people mess up. They try to get fancy. They think they can time the market, picking the perfect moment to buy and sell. They chase hot stocks they heard about on social media, or they try to day trade their way to riches. This is like trying to win the lottery as a retirement plan. Sure, it's possible, but it's also a great way to lose everything. The smart move is boring, but boring makes you rich. You buy a diversified collection of stocks and you hold them for years, ideally decades. You don't try to time the market because nobody can do it consistently. Even the professionals who dedicate their entire lives to this stuff get it wrong most of the time. Speaking of diversification, this is probably the most important concept in all of investing, and it's dead simple. Don't put all your eggs in one basket. If you invest all your money in one company and that company goes bankrupt, you're screwed. But if you spread your money across hundreds of companies in different industries and different countries, the failure of any one company won't destroy your wealth. This is where index funds come in, and they're basically the greatest invention in the history of investing for regular people like us. An index fund is like buying a tiny slice of hundreds or thousands of companies all at once. Instead of having to research individual companies and pick winners, you just buy the whole market and let capitalism do its thing. The beauty of index funds is that they're cheap, they're diversified, and they require zero skill or knowledge to use effectively. You literally cannot screw this up unless you panic and sell during a crash, which brings us to the most important rule of investing. The most important rule of investing is this: don't be an idiot when things get scary, and things will get scary. The market will crash, your portfolio will turn red like a horror movie, and every financial news channel will be screaming about the end of the world. Your neighbors will be panic selling, your coworkers will be freaking out, and your brain will be telling you to sell everything and hide your money under your mattress. This is exactly when you need to do the opposite of what feels natural. When everyone else is selling, that's when stuff goes on sale. It's like Black Friday for investments, except instead of fighting over discounted televisions, you're buying pieces of profitable companies at bargain prices. I learned this lesson the hard way during my first major market crash. I watched my portfolio drop by 30% in a few weeks, and I absolutely lost my mind. I sold everything, convinced that this time was different and the market would never recover. Then I sat on the sidelines eating ramen noodles and watching the market climb back up without me. By the time I got the courage to invest again, I had missed most of the recovery. That mistake probably cost me more money than every other investing error I've made combined. The people who get rich from investing are the ones who buy when everyone else is selling and hold when everyone else is panicking. It sounds simple, but it's incredibly hard to do when your portfolio looks like it got hit by a financial tornado. But here's the thing about market crashes. They happen all the time, and the market always recovers eventually. Always. We've had the Great Depression, multiple recessions, dot-com bubble, housing crisis, global pandemic, and every single time people thought it was the end of capitalism as we know it. And every single time, the market came back stronger than before. Now let's talk about bonds, because you can't have a complete investing education without understanding these boring but important pieces of your portfolio. If stocks are like owning a piece of a company, bonds are like loaning money to a company or government. They promise to pay you back with interest after a certain amount of time. Bonds are generally safer than stocks, but they also make less money over the long term. They're like the vanilla ice cream of investing. Not exciting, but reliable and predictable. The older you get, the more bonds you should probably have in your portfolio because you have less time to recover from stock market crashes. The basic rule of thumb is to subtract your age from 100, and that's the percentage of your portfolio that should be in stocks. So if you're 30 years old, about 70% stocks and 30% bonds. If you're 50, it's 50-50. This isn't a perfect formula, but it's a decent starting point for people who don't want to overthink it. Here's where things get interesting though. Most people think investing is just stocks and bonds, but there's a whole world of other stuff you can put your money into. Real estate, commodities like gold and oil, cryptocurrency, collectibles, you name it. Some of these can be good additions to a diversified portfolio, but most of them are either too complicated, too risky, or too expensive for beginners. Real estate is probably the most popular alternative investment, and for good reason. People need places to live, and real estate generally goes up in value over time. Plus, if you buy rental properties, you can get income every month while your property appreciates. But real estate also requires a lot of money up front, ongoing maintenance, dealing with tenants, and it's not nearly as liquid as stocks. You can sell stocks in seconds, but selling a house can take months. Gold is another popular option, especially when people get scared about inflation or economic uncertainty. Gold has been valuable for thousands of years, and it's not going anywhere. But gold doesn't produce anything. It just sits there being shiny. Over the long term, stocks of productive companies tend to outperform gold by a wide margin. Then there's cryptocurrency, which is either the future of money or the biggest scam in history, depending on who you ask. I'm not going to tell you whether to invest in crypto or not, but I will say this. If you don't understand what blockchain technology actually does and why it's valuable, you probably shouldn't be putting significant money into it. Too many people are buying crypto because they heard someone made $1 million on Bitcoin, not because they understand the underlying technology. Whatever you decide to invest in beyond basic stocks and bonds, remember the golden rule. Don't invest money you can't afford to lose. Your emergency fund, your rent money, your kids' college tuition, that should all be in safe, boring savings accounts or short-term bonds. Investing should only be done with money you won't need for at least 5 years, preferably much longer. This brings us to one of the biggest mistakes people make. They invest money they need for short-term goals. They put their house down payment in the stock market because they want to make it grow faster. Then the market crashes right when they need to buy the house. Don't be that person. Investing is for long-term wealth building, not short-term money storage. Another huge mistake is trying to get rich quick. I see people all the time throwing their life savings into whatever stock is trending on social media, convinced they're going to be millionaires by next Tuesday. These people usually end up broke and bitter, blaming the system instead of their own poor decisions. The reality is that building wealth through investing is slow and boring. It takes years, usually decades, to see life-changing results. But the people who stick with it and don't do anything stupid along the way end up with more money than they ever dreamed of. Everything I just told you can be boiled down to a few simple rules. Start investing as early as possible because compound interest is your best friend and time is literally money. Buy boring index funds instead of trying to pick individual stocks. Don't panic when the market crashes. That's when you should be buying more, not selling everything. Keep your costs low, diversify your investments, and don't